I want to welcome you to the webinar today that is a review of the U.S. stock market. We're also going to get into auction market concepts, auction market principles, the market profile graph, and bar charts, analysis. And one thing that I want to give you a heads up, when I was doing the webinar, my screen was not projecting for the first, 5 to 8 minutes. Now, I was going to edit that out, but I'm going to leave it in because some of the comments I made that I did attempt to repeat, I want you to hear. But the slides, and you can fast forward through this if you want to find where I basically started the slides over that match up with the text you're going to hear. But I'm going to leave that text in there because I think it's important. So you won't see the slides. If you want to skip forward, go forward about, somewhere between 5 and 8 minutes. And that's when you see the slides get in sync with my comments. So I want to thank you for watching. I hope you find value in this. Okay, welcome everyone. It is Saturday morning, February 6, 2021. It is 10 a.m. Eastern time in the US. And I thought this would be a really good time to do a stock market review, and included in today's stock market review, hopefully we can review a few things about auction market concepts, the use of the market profile graph, why those things are particularly important now. They're always important, but there's some real lessons here, and it's a very, very exciting time to be in the market now. And we'll get into that in just a minute. But anytime the U.S. stock market, any of the 4 primary trading indices, the Dow, the Russell, the S&P, or the NASDAQ are at all-time highs, it brings the prognosticators out of the woodwork, and they start making extraordinary predictions based on their particular form of magic, whether they are technical analysts or whether they are fundamental macro analysts. And you'll have these wild projections for the market to go higher. You'll have these wild projections that the great Armageddon fifth of a fifth is occurring, and we're going to have a financial collapse. So if you are a trader, you learn over the years to just sort of yawn. And hopefully, if you have something that's valid, it's a great time to be trading, because where we are right now from an auction market perspective, we're at an inflection point. And in auction market concepts, principles, inflection points are areas from where you're going to have a very sharp move relative to the time frame around it. So that's where we are. We're perched in new all-time highs. And the indices have sort of been back and forth in this area for several days, if not weeks, quite frankly. So I think we're on the cusp of something very significant. So how do we trade that? Where are we? Let's take a little bit deeper dive into that. Some of you are not current clients. Briefly, this is the website. You can go check out the resources there. My name is Tom Alexander. I've been trading 36 years. My trading experience is on the website. I trade and teach auction market principles. The tools I use in my trading and my teaching are the market profile graph and bar charts. There are 2 unique features of auction market principles, just 2. And while they're only 2, they're quite profound. Number one, it actually works. It's one of the few things out there in trader land that works. 99% of the nonsense out there on Twitter, on YouTube, in your email box, the magic does not work. Everything that I trade and teach, I do in a completely transparent manner with an explanation behind it. And I always challenge anyone that takes a look at my work to prove me wrong. If I'm missing something, I want to know. So please, you'll be doing me a favor to show me I'm wrong, just email me. I'll be happy to get on the phone with you. If you can clarify something I'm doing this wrong, I want to know. The other feature, and this is perhaps the most important feature from a trade. Well, it's not more important in the fact that it works, but it's just as important. These concepts that I'm going to share with you today. Now we're really going to spend time on intermediate to longer term views of the market, but everything that I'm showing in here in terms of conceptual analysis works intraday. It works in any time frame. Any time frame you choose to trade, these concepts work. Now, there's a lot of noise, and anytime the market does something that people don't understand, it's different this time. The markets are being manipulated by the Fed, the government, foreign governments, small traders, large traders, hedge funds. I can go on and on and on. No, none of that has changed. Markets have always been manipulated by anyone that can find a way to manipulate them, and they always will be. It's just what you dial up when you're in this business. Again, I've been trading 36 years. I was trading in the mid 1980s with Ivan Boesky insider trading scandals. I mean, it's always something, and it will always be something. What has not changed ever is this auction market process. The auction market process of development is as robust as it's just robust. There's nothing that comes close to its robustness. In other words, its validity in any time frame. Now, some things have changed. The auction process of development has been sped up by technology and by an increase in volume and things like that, but it has not changed. And it's the principles, the concepts are in effect every single day, every single second, minute, hour, whatever. This is one of my favorite quotes from Peter Stettlemyre. Peter Stettlemyre, as most of you know that have any tangential brushing with market profile, Peter Stettlemyre is the guy that initially posited the concept, and I'm not going to get into it any more than that. You can Google Stettlemyre and find out who he is, but he's considered the father of market profile. And this was a quote he made in 1996, 25 years ago. The evolution of the fundamentals of market profile has been lost on the majority of users because most of the interest was in using it to make trading decisions rather than in understanding the market. And this was some of Stettlemyre's best work about trading really has nothing to do with market profile. In this particular book, I highly recommend it. He says some extraordinarily profound things about trading in general. But it's fascinating to me as a trader, and I've been trading 36 years. I traded for over 20 years before I got into the trading education business. And when I got into the trading education business, it was head scratching at the time, and it's still head scratching today. There is more nonsense peddled in trading education than any business on the planet. There's no regulation. Anybody with an internet account now can open up a business and sell you some form of magic. And that's what most trading education is centered around. It's centered around nonsensical magic. It's total bullshit. And market profile has been hijacked by the magicians, and it's used as some sort of magical charting format. And that's all it is. It's a charting format. There's no magic to market profile. It is a way of displaying data, price data. Now, it's unique, and used properly, it can be very powerful. But here's Stettlemyre 25 years ago, basically explaining what market profile is for. It's to understand the market. If you don't understand the market, you have no chance of succeeding or of sustained success. Anything will work some of the time. 99% of the stuff out there that works some of the time, it isn't valid. It's just randomness, by chance. If you flip a coin to go long or short, and 100 people do that, there'll be 2 or 3 people that 10 times in a row go the right direction because the coin lined up with randomness. And that's what that's how most people are trading. Okay, enough of my rant and soapbox. I want to show this is one of the best illustrations of the robustness of auction market concepts that I think you can see. It's basically the market profile graph, and the market profile graph displays the auction process. That's how we get this Gaussian shape, and that occurs over and over. It's that auction market three-step process of development that's in effect that consistently creates this Gaussian shape. So this is the Dow Jones Industrial Average in the 1920s, 1930s. This is the 1929 top. And you can see, this was the crash. This was into the Depression lows. This is the 1932 low. You have this Gaussian shape. So, and if we could go, I don't have, excuse me, I don't have intraday data, but if I did, you'd see the same thing. The auction process is truly fractal. You hear the term, this is fractal thrown around a lot, but this is something that is truly fractal. And it can be, it's typically quite clear. It's not nebulous. It's not like, say, Elliott wave, where there are 75 permutations at any given point in time, what a count could be. And if it moves, slightly above this level, it changes to the next 35 iterations of what the count could be. This is pretty binary stuff, which makes it good. It makes it simpler, it makes it clear, and it's truly fractal. It's not based on magic. It's based on auction market principles. It's based on how auction markets develop. It's based on how they have to develop because of the design of an auction market. Ooh. Let me see what happened here, guys. We have a, hold on a minute. Let me go back. Okay, I'm going to go back and let's you guys, hold on a minute. I don't know what happened. Hold on. We'll figure it out. Okay, now, do you see my screen now? Okay. Okay, so, all right, I'm going to run through these slides real quickly. I've already given the outline, who I am, the website, the most important and unique features of auction market principles. And I'm just going to repeat this whole thing because I'm recording this and I'm going to send it out to people that aren't here. So the most important and unique features of auction market principles, there are two. It works and they are robust. Now, both of these things are profound and they are surprisingly rare. That's just the way it is. And very few things in trader land out there actually do work. This works. Markets have changed in some ways. We have an increase in transparency. We have an increase in activity, but auction market principles have not changed even slightly. This is maybe my favorite Peter Stettlemyre quote. It's from his book, 141 West Jackson, that was published in 1996, 25 years ago. Now, for those of you that are familiar with market profile, you have to know who Peter Stettlemyre is. If you don't, you can Google him. But he was a floor trader that posited this concept from his visualization of what was going on in the auction on the floor as a way to help off-floor traders and actually on-floor traders at the time understand what the auction was doing. And there's a whole history and evolution behind this. And I go through that in one of my books. I'm not going to do it today. But the point of this is that in trading education, It is the biggest minefield of magic and nonsense of any profession that you can imagine. Anyone can open up a business on the internet and sell magic to traders, and there is a never-ending supply of customers that want some sort of magic that makes trading easy. Trading is not easy. Trading is a fascinating, wonderful profession, but it is a profession. And like other professions, there's a learning curve. There are things that are valid. There are things that are not. The problem with trading education is that 99.9% of the stuff you see on YouTube, Twitter, in your email box is not valid. It's some form of magic. The auction market principles are immutable and, to the best of my knowledge, irrefutable. If I am wrong about this, I want to hear from you. Let me know. I've always issued this challenge. If I'm wrong about anything I say, let me know. Send me an email, tom@alexandertrading.com, or call me. My phone number's on the website. Happy to discuss it with you, and you'd be doing me a favor to show me where I've been going wrong now for 36 years. But the point of this is that market profile, like everything else in trader education land, has been hijacked by the magicians to use as a form of some sort of magical graph. It's not. It is a way of displaying data. It does it in a unique way. It does it in a way that shows, if you understand how to read it, the auction process of development. So it can be a very powerful tool, but it is just that. It is nothing more, nothing less than a tool. So I want to visually show you the robustness of the auction process. And the profile graph does a very good job of that, because the auction process is what creates this Gaussian shape. And it's the market profile, the ingeniousness of how data is displayed using the profile graph, that shows the consistency and the robustness of the auction process over and over and over in all time frames. Now, these are quarterly profiles going back to from 1928 into October 31. This is the October 29 top. This is the low in the 1930s. 1932 was the low of the Great Depression low. Okay, let's see here. Here we go. Okay, do you guys see my slide that shows ES intermediate term auctions? Because again, there's some sort of interesting, odd thing going on, and I want to make sure. Okay, this is not honest. I apologize. I really don't understand what is going on here. Let me find the slide I want. And I'm going to bring it over here. Okay, now you guys see that? You see the ES intermediate term auctions? Is that what you're seeing? Okay. We'll try it this way. So here's the ES. This is the February 20 top. This was the March low. You can see this Gaussian shape that forms more or less always in an auction structure. And this is where we are right now. So now if you look at this, just at face value, we're trading at an extreme, upper extreme of the stock market. I mean, we're at all-time highs. There is nothing above us of substance. There is no way to predict using any sort of magic, Fibonacci retracements, projecting earnings and extrapolating that nonsense out. It's all magic. Nobody knows where this thing can go. It's an auction. It will go higher until it runs out of buyers. It's that simple. And it's no more complicated than that. This is where we are. This is what is. Nothing gives you a clearer picture of reality of right now of what is than this methodology. So this is where we are. There are no if, and, or buts about it. it's just the way it is. All right, let me see here. Let me make sure I've got another set of slides here working so that I make sure. Okay. All right. Now, what I have done, I have split out the profile because the profile is basically a bar chart of letters that overlap. And when you split it out, it becomes a bar chart, but instead of bars, what would be bars are letters. And it's helpful to use to be able to understand how to manipulate the market profile graph to get a better picture of market condition. That's what Stellermeyer was talking about. You use the purpose of market profile is to understand market condition, to understand what the market is doing. So where are we? Well, we're in so far for 2021, we're in a relatively narrow range auction. On Friday, I think we closed at all-time highs. And so we can use that. This is what is. It's not a projection. It is reality. We are at new all-time highs. There is no quote unquote resistance above us. There isn't any. What is resistance? You don't know what resistance is until the market bumps up against previous activity to know that, yeah, there's resistance. Now we can identify because we have downside trade activity, which is something that's valid, it's consistent, and it's objective to help us identify downside key reference areas. Key reference areas are inflection points created by the auction process. And they can, and I want to use these two terms cautiously, they can provide support. But what they are inflection points. They are areas that if reached, you're expecting a move outsized relative to randomness, relative to the same time frame trade that surrounds it. For instance, over here, this was the top back a year ago, almost exactly, as a matter of fact. We formed a minor balance area. Now understand, these are weekly, these are quarterly profiles. So each one of these letters is 1 week of trade. So there's more in here than it looks, but we formed this balance area here. This was the low extreme of the balance area. This was the inflection point. This was the area that if reached, you're expecting a sharp move. And indeed, we cratered. So just looking at this simply, and this is about a 41 handle scale over here. So I'm not sure if 3663 is the low for the trade in the ES this year, but it's somewhere around this level. I think you get the point of the slide here. But it's very obvious. If we take out 3663, it's a heads up. It's a big time heads up. So that's really the punchline. If you want to know, all right, well, how do I trade this? Well, if it goes below 3663, you want to take a hard look at your positions. First of all, if you're long, you want to take a hard look at what's going on at the point in time this level is broken. If you're thinking about going short, you may want to go short or orient yourself to the short side of the market. Now, we can fine tune that, and we'll do that. There's more involved in this. So we have this 3-step auction market process that's fractal. It's occurring in all degrees of time, all the time. So let's look at the February auction. Let's look at where we are now. Now I'm going to do a very dangerous thing, and I'm going to stop the slides, and we'll come back to it, hopefully. Right. Okay, hold on a sec. All right, let me get my chart over here. And we'll come back to this slide as well, which is a very interesting slide. But let's take a look at now this. Okay, do you guys see my chart? Just want to confirm this, because as soon as I don't confirm it, we won't see it. Okay, so you can see the February auction. So what we have here, this is the daily configuration, profile configuration. And basically each one of these profile units that you see is 1 month of trade. And again, if I split these out, well, basically you have a bar chart. Okay. So here we are in the February auction. What is different? What is different on this screen in these units, these profile units this way? Is anything different about all this other stuff and now? Well, there's something that's very, very different about this. It's vertical. There's been no development, and development is going to occur. You are going to, at some point, develop in this range. Now, we don't know where, but we do know that even if the market goes a lot higher, it's not going to go higher at this rate of change. It can't, it won't. Now, the market has gone an extraordinarily long way. I mean, it did in November. November was a very similar picture to what we're seeing now. Let me split out November for you, okay? Okay, so here's November. I mean, November was insanely vertical until it began to develop. And this is what happens in all markets in all degrees of time. When a market goes dead vertical, remember I talked about that three-step process of auction market development that's in effect in all degrees of time all the time. This is step one. Now, step two is only identifiable in hindsight, but there will be a stopping price. And the stopping price is not necessarily the high or the low extreme. It's typically the price around which the market begins to develop. So the stopping price basically occurred on this day. And then what did we do? Well, we formed this Gaussian shape and we developed. Time regulates price. So when this structure formed here, this was a very, 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 very important level. And we haven't broken this level since. And then you begin the next auction. And you develop. The market trades higher and then it develops and then the market trades higher. So you have this balance, imbalance, balance that's occurring in all degrees of time, all the time. What has not happened in the February auction? There's no development. I mean, you had 2 or 3 days, and I'm going to show you these days in here because it's a great lesson. The auction process is extraordinarily fractal, and that's what makes it so valuable as a way to develop a trade plan, because you can use this concept to identify smaller degree auctions that have the risk of that smaller degree with the potential of the much larger degree. So here we are in the February auction. What comes next? I can't really tell you. We don't know that this is over until it begins to develop. So we have to go down in time frame to give us cues. I mean, the market is in clear vertical development now. Anyone that's selling this now is playing an extraordinarily dangerous game called pick the top. It's the twin of pick the low. It's unnecessary and it's just plain stupid to do that. There is no quote unquote resistance above where we're going. No one knows how high this thing is going. But I do know with certainty that we're going to get more development in February than we're seeing now. Now, that development may not start until we're up here, but you're going to get it. It's going to occur. It's just, I'll retire if it doesn't occur. How about that? So you're going to see this at some point. You don't know if it's here We don't know if it's already started. We don't know if it's even higher up here, but it's going to occur. It always has. If it doesn't occur, this will be the first time ever in history that it didn't occur. So I'm going to make the bet that it's going to occur. Now, that's not necessarily tradable information. It's more of a heads up. And today's webinar is sort of a blunt instrument. If I'm, depending on the time frame trader I am, if I'm long this market, I am happy as a clam. But I'm also keenly aware that this immediate party, I want to be a little bit cautious about pressing the long side the higher this market goes, because at a minimum, I'm looking for some rotation. So that's how this particular view has a practical application for traders or investors. Again, the auction market process, three-step process of development is in effect in all degrees of time all the time, which makes it a tradable methodology regardless of the time frame you trade. We trade the same concepts in our live trade room that I use to swing trade ETFs, position trade for stocks, all of these other things. I trade all instruments. I trade futures, stocks, ETFs, options. I use this concept to trade all of that, and you can too. So anyway, this is where we are. Now, at this point, let me go back to here. Okay, do you see my slide? I want to make sure. Okay, so this was last week. This was a multi-session auction comprised of 3-day sessions and some Globex trade. And the letters, the reason the letters are colored on my screen, I use this in intraday analysis because, again, the auction process is fractal. And the sessions have a single auction market session that's parsed out into 30-minute rotations. In my mind, I posit the idea there are 3 distinct auctions. You have the day trade, which is black. You have post midnight, which is midnight to 6 a.m. And then you have the blue, which is 6 a.m. into the day session again. And again, this gets back to proper use of the profile graph to determine market condition. And that you can only make this tradable by using it in that manner. And you have to understand how to manipulate the data, the market profile graph itself, to get the best view and to identify the most important levels. But what this shows is a beautiful fractal process of the migration of value higher that you can see on the longer term chart, where you have these high volume nodes. This protrusion of letters is the area of greatest value in a defined time frame. So you had this mature structure, balance. What follows balance? Like night follows day. Imbalance. What follows imbalance? Like night follows day. Balance. This is where we closed on Friday. So the immediate structure to keep an eye on heading into Globex on Sunday evening. Now, Sunday evening will give us different additional information, but the key reference areas, I'm going to move this again, and we'll go down in time frame a little bit. So the key reference areas as we head into, now I'm going to parse this out into its day sessions, because that represents the cash market, which are the levels that I lean most heavily on. So here's the day session from Friday, pretty narrow range day session. So to the downside, I'm interested if this level breaks, and I'm really, really, really interested if this level breaks, because Thursday's low is at a confluence of the high volume node from all this trade over here. Now let me see if I can accurately parse this back out. Yes, there we go. So that makes, these are 2 important key reference areas. You have a high volume node from a mature structure, and you have the extreme of a distribution of imbalance that began that has continued higher since. So as a trader, really in any time frame, the two downside levels I'm most interested in are Friday's low that includes some high volume from Thursday's trade in Globex, and then the low from Thursday that includes Globex trade and volume from previous 2 or 3 sessions. That's all I need to know. Now, what's quote unquote resistance? Well, again, there really isn't any resistance. All you have to work with as objective is Friday session highs. Now, Globex will change the picture a little bit. All mature auctions have 3 primary key reference areas. You have an upper extreme, a lower extreme, and you have a high volume node. These are your inflection points for trade. Now, I don't want to get too deep in the weeds here in the minutia, but as long as you're above the high volume node, in general, emphasis general, you want to be favoring longs. If you're short, you want to be favoring, if you're below it, you want to be favoring shorts. Now, it's not quite that simple, but close. So that's sort of where we are. Now, let's see. Let me go back over here and see. Okay. Pull my slides back over here. Okay. Do you see my slide? Slides now? Someone? Okay. So the initial signal of a top of significance is when these downside key reference areas, the auction market extremes, upper extreme, lower extreme, high volume node, begin to break in smaller degree auctions. This is the beauty of the fractal process of this. And the beauty of it is it's so consistent. It's objective. It can be, it's more binary than most things, than anything I'm aware of in discretionary trading. Now, I want to emphasize it is discretionary trading. There is judgment involved. And it's, I've been doing this 36 years. So things that are obvious to me are not going to be obvious to someone that hasn't been using it as long. But I train people that in a relatively short period of time, they're going to see the same things that I see for the most part. Okay, let me see here. Let me get this out of the way. Is this, what's the next slide here? Maybe that's the last slide. Okay, now I want to show a couple of other things about that I think are immediately relevant to the present situation that sort of fall under the category of 36 years of experience. All right, here are the 4. All right, you guys see my charts, by the way. Again, I want to make sure. Okay. So here are the 4 primary U.S. trading indices. It's the ES, the NQ, the Russell, and the Dow. But these are the futures contracts, but the cash markets are basically exact same concepts. Now, what we have are all 4 of the indices are pretty much in lockstep. There's a minor divergence because the Dow did not close in a new all-time high, but you can see we're vertical off of this low to the upside big time in all 4 of the indices. So they're in lockstep. And that's something you look for because at all market turns that I can recall of significance, lows and highs, you have divergence at the extreme among and or between the indices. Right now we're in lockstep. That's telling me that the institutions, the people with the big money that press the buttons, that drive the market, there's only one party in the market that can drive it directionally and sustain that direction. That's big money. It's not you and me. So you don't want to fight the market. That, again, I get back to the idea that this is a present. You're viewing what is. You're not viewing a projection. You're viewing what is. There is enthusiasm for this market. So unless those minor auction levels begin to be broken to the downside, the trend of this market is up. I can't tell you how high it's going to go. And you know, I'll admit that the people that are trying to tell you how high it's going to go are in the business of selling magic and telling you that there's some magical method of projecting where a market tops out. There isn't. Somebody will ultimately call the top of this market, just like somebody ultimately called the top in February 2020, just like somebody ultimately called the top in 2008. It's just never the same person. Okay, the last thing that I want to show you that we use, I want to show you a very simple tool. The indicators you see on my screen are basically the red and the green are moving averages of New York Stock Exchange breadth. NYSE advancing minus declining issues. This is breadth down here. The red is a 10-day moving average of just advancing issues. The green is a 5-day moving average of just advancing issues. I use these as a sentiment indicator. It is auction market information because we're trading indices. The indices are comprised of components. It's a measure of sentiment. It's a measure of health of a trend. It is the proverbial blunt instrument. It is not tradable. It's sort of a warning. It's a heads up. It can give you clues as to the maturity of a given market condition. And in particular, I want to point out here, the 5-day moving average of advancing issues has never been higher. Ever. That's a lot of upside momentum. Now that tells me a couple of things. Also, I'll show you short term here. Something else that's interesting. We've had this huge. Last week was a huge expansion in breadth, but it ended the week on a divergence, less breadth. Now the net advancing issues went out on a high on, and this is the SPX, by the way, this is S&P cash. So what can we expect? Well, let's think back. Let's think back to the auction process. Let's think back to that market profile graph. And let's think back to what hasn't occurred yet. What hasn't occurred yet is this. We haven't had this occur. Now, market can go a long way, but again, it's not going to go like this indefinitely without doing this. It's going to do this. But doing this is not necessarily a sign of, well, it's not a sign of an imminent top. It's a sign of normal market development. So let's take a look. What happened here? Well, we formed balance, and then we had a run up, and then we formed a little bit of balance, and then we had a run up, and the market became more two-sided. Now, it went a lot higher, but it slowed down the rate of change that we were seeing off of this late October low. So we had this huge ramp up, and then we've gone a lot higher since then. You know, since this high, or I'm gonna go from the close, okay, into the close. Let's just see how much we're up, okay? We're up almost 10%, right? And but this ramp took, let's see how much we were up into the close, okay? So from the low into the high, we were up about 9.5%, well, almost identical, right? But this took 1, 2, 3, 4, 5, 6 or 7 trading days. This has taken 4 months. So yeah, we could go a whole lot higher, but we're not going to go higher at this rate of change. So what is very, very, very likely going to happen sooner rather than later, we're going to start to see this. We're going to start to see balance. We're going to start to see the market become more two-sided. Now, this, the decline that occurred a couple of weeks ago was an opportunity for the market to fail, and it didn't. Something else I'm going to show you, sorry to digress here, but every single instance since the March low, and there were 7 of them, when breadth has reached negative 2,000 or greater, we've rallied immediately. And in 5 of those, we've rallied immediately to new highs. We have not taken out a single previous price low accompanied by a negative 2,000 reading since the March low. So that makes this level super important. Let me clear this for just a minute. So what's going to happen next is we're going to have some balance. I don't know when it's going to happen, but again, from a trader's perspective and trading different time frames, if I'm long this market and leverage ETFs and swing trading, I'm lightening up. And I'm willing, if we double from here in the next 4 days, okay, I miss it, but that's a low probability event. The highest probability event here is that this trend really soon begins to slow. Now, is it possible to have this inverted V top all of a sudden? Yeah, it is. And well, how we're going to know if this happens? We'll miss everything. Well, not necessarily, because if we're going to have an inverted V top, it's going to have to take out Friday session low, and it's going to have to take out Thursday session low. But the very initial signal that's valid is a close below Friday session low. And as a trader, that's very comforting to know that I have something objective that I can lean on that has validity to it. So yeah, could an inverted V top occur? They're really, really rare, but they clearly do occur. And actually, you had balance here that was taken out last February, and that would be a similar. We don't even have 2 or 3 day balance here. I would be surprised, but anyway, if you want to know, well, gee, how do I catch the inverted V top that I just know is going to happen? Well, that's fine if you know what's going to happen, but I implore you to be smart about your vast knowledge that is unique, and let the market give you a signal. So if you go short here and the market crashes, at least you have an objective way to say, oh, okay, that's what if that happened? What if we close below this? You go, okay, well, Tom, where's my stop? That's the question I always get in the live trade room during the day when I say, okay, if this is taken out, I'm short, this is taken out, I'm long. And people go, well, where's your stop? And I go, well, I don't know right now. I have to see what happens when it's taken out. But if I split this out, what will happen inevitably if we take this out? You will form, let me get my drawing tool. If we crater down here, you're very likely to do some number like this. So you'll form a minor balance area in here. And then if we break to the downside, my drop dead stop on an intermediate term trading perspective is right here. So I've just given you, this can be the basis of a trade plan for those of you that are actually paying attention. This, what you just saw is how I trade. And I trade that way in all time frames. Okay, so back to this for a minute because I want to caution you. You know, the people here, and we're all biased by our emotions and our beliefs, and we see and hear what we want to see and hear. And so invariably, I'm going to have people that are listening to this going, oh, wow, look at that divergence. I'm going to start getting short because this is incredible. It's magic. It works every time. And I'm going to be the first one in the pool. It's not a good idea. You can have these divergences that carry on for so long. It's just unbelievable. For instance, we had this incredible rally, 13% rally, and continued divergence in these indicators. And this lasted from October of 2019 into, well, the February 20 high. So don't, you have to put this in a context. And something else that those of you that are clients have heard me say 7,000 times, will hear me say 7,000 more times: default to market structure. Auction market structure is your friend. It is reality. It is what we're trading. For better, for worse, we're trading price. And the auction market worldview of price gives you something objective to trade. I mean, I've seen the market go up for days on negative breadth. So keep that in mind. What will always, always bail you out is if you understand the auction and that it's fractal and how to use the fractal nature of the auction. You don't need to be, if there's anything significant that's going to occur to the downside, you can afford to wait until it takes out Friday's low. Now, what I'd like to see happen under the category of what I'd like for Christmas is I'd like to see this start to develop. Now, a lot of people don't like a chop fest, but I've learned to embrace the chop fest because I understand what's going on, and it makes the market, it gets to a point where you can get great trades out of this. And you understand how to trade. That's another thing about this methodology. You understand market condition, and you can fit your trade strategy and your tactics for the market condition. So if we begin to get into some sort of a chop fest, I'm going to trade that differently than I'm going to trade vertical development, particularly vertical development that appears to be in its maturing phase. And if we go up Monday and Tuesday, it's going to be quite mature. So any questions about this, guys? Can I show an example of the last slide? What slide is that? Hold on, I'm not sure. This? Casey, is this what you're talking about? An example of the last slide? Text slide. Let me see. The initial signal of a top of significance when downside key reference areas begin to break in smaller degree auctions. That? Okay, here it is. All right, let me go back. You mean to the down? All right, let me find it. Okay, perfect. Let me go to the bar chart so I can identify when we had a drop, but I think I'm on the right track here with this. Okay, let's look at this for you. This was January 26, right? We had a little bit of a balance here, and then the market fell out of bed. So let's go back over here. And here's January 26th, right? So we came into the 26th. And we had, this is the day session on the 26th. This is Globex that followed the day session. So on the 26th, what happened was we spiked to a new high. And then the market, we had a pretty narrow range auction, and the market began to develop. Now, where did we close on the 26th? What? Oh, okay. Here's the Globex close. This is where somewhere right in here, well, somewhere in here is where the day session closed. And then you had Globex, and Globex began to trade, the value began to migrate lower. But Globex, this is Globex from 6 a.m. from midnight into 6 a.m. And then this was the 6 a.m. into the day session open on this day. So you were probably, if you're paying attention, you were in trouble because you had potential trouble. You had this giant volume node from this increasingly mature auction here. Then you had the 26 develop inside that volume node, and it closed in the low extreme of the high volume node. And then you had the overnight auction, and it basically was a double distribution in market profile parlance, where you had a mature auction here. The value began to migrate lower. You developed around that structure, and then we just completely fell out of bed. Is that what you're talking about? Miguel, you asked the question, how do you define your risk when you don't put your stop initially? Well, you can put your stop initially, but you don't know where your stop is. You don't always know where your stop is when you enter a trade. At a minimum, it's the extreme of the previous balance area in the degree that you're trading. That's the drop dead stop. But a lot of times when you get put in a trade with conviction, and this gets out of the purview of this particular webinar. I mean, we're getting deep into the weeds of strategy and tactics here. But you can often fine tune your stop. When you take a trade, when you let the market put you in a trade at an inflection point, you're probably going to get a chance to really use a tight stop relative to the potential return. Any other questions? Okay, Meyer, you said, all right, this is good. You said that this two-sided daily development should resolve in a sharp move. On the other hand, you said today that we should expect balance this month. That's a conflict. No, it's not. It's not a conflict at all. I also said the auction process is in effect in all degrees of time all the time. From a daily perspective, the more likely thing that happens is balance. Which balance areas hold more weight on the profiles or candles on a chart? Or are they one and the same? They're the same. You sort of train yourself to view this. If I'm looking at a bar chart, I see quote unquote market profile. Now I can't look at a market profile and see a bar chart. I have to split it out. And that gets back to Stoudemire's quote. The purpose of the profile graph is to help you understand the auction and to help you identify the present market condition. Sometimes a profile graph is better at that than a bar chart. Sometimes a bar chart is better at that than a market profile graph. People typically find me because of quote market profile. I'm known as a market profile guy. But I tell people very quickly, I'm not a market profile trader, and I don't want you to be a market profile trader either. I want you to be an auction market trader. It's an understanding of how markets develop that gives you the opportunity to develop a valid trade plan any time frame you trade. The tools that are helpful are the market profile graph and bar charts. What do they're kludgy. And what do I think of the TPO charts on Thinkorswim? I use Thinkorswim as a trading platform for some of my accounts, and they're too kludgy. They're not. They're too difficult to work with. Anything else, guys? Comments, observations? Okay. Um, thank you all for your time today. I'm going to be doing more of these things. You guys have a great day. Have a great weekend. I'll talk to you soon.